Hi everyone, welcome back to the channel. So have you ever felt like your rental portfolio is starting to feel more like a second job than a passive investment? Between tenant calls and maintenance repairs, a lot of real estate investors end up realizing their so-called passive income is anything but passive. In this video, I'll break down 3 different strategies to make your rental portfolio more passive. I'll cover triple net properties and why they can be the closest thing to mailbox money for directly held real estate. Then I'll look at UPREITs, which allow you to transfer management of your property and eventually become part of a diversified portfolio of real estate. And finally, I'll talk about Delaware Statutory Trusts, or DSTs, which can be a great tool for 1031 exchanges and truly hands-off ownership. Let's start with triple net properties. If you've been a landlord for any amount of time, you might know the pain of getting that late night call from a tenant about the toilet overflowing. With a traditional lease, you as the landlord are on the hook for almost everything: repairs, property taxes, and insurance. A triple net lease flips that script. In a triple net deal, the tenant typically pays for all 3 of those costs. So what does that leave for you? Collecting rent and paying the mortgage. Now, that's not to say this is completely passive. You still need to make sure that the tenant is actually paying these expenses, because at the end of the day, you are the property owner. In addition, at the end of the year, there may be some extra reconciliation of expenses, as things like property taxes, insurance, and common area maintenance charges, often called CAM charges, can change during the year. So you may have to refund the tenant some expenses or bill them for more at the end of the year, depending on how far off the expense estimates were. Now, who are these tenants? Typically, you see triple net leases for commercial tenants, which can range from mom and pop shops to massive corporations like Walgreens, Dollar General, and Home Depot. Triple net leases also tend to be longer, with leasing periods of 5, 10, or even more years. Many companies will even guarantee the rent for individual locations. So for example, let's say you owned a building that Dunkin' Donuts was renting from you, and there's a 10-year lease, but 5 years in they close down. Well, Dunkin' Donuts corporate may actually guarantee the rent for the remaining 5 years of the lease. Of course, nothing in real estate is perfect. The trade-off is that these properties often have lower returns compared to a typical directly held real estate investment. You're basically paying a premium for the stability. But for someone who's tired of the daily grind of landlording and wants consistency, this can be a great way to simplify your life while still directly holding real estate. Next, let's talk about UPREITs. If you ever thought about selling a rental property, you probably ran into a problem of capital gains taxes and depreciation recapture. An UPREIT offers a clever solution for landlords who may no longer want to directly own real estate. UPREIT stands for Umbrella Partnership Real Estate Investment Trust, and here's how it works. Instead of selling your property and paying taxes, you can contribute it into the UPREIT in exchange for operating partnership units. The advantage is that you're not triggering capital gains taxes when you do this. The REIT then becomes the general partner and manages the property. You even have the option of converting the partnership units into REIT shares. However, this would trigger a taxable event, but you would be swapping your property for a slice of a much larger real estate portfolio, one that's managed professionally and often diversified across multiple property types and locations. However, there are trade-offs to UPREITs. First, you give up control. You can't decide when properties are sold or how they're managed. If the REIT sells your property, you may recognize taxable gains even if you personally didn't choose to sell it. And unlike direct property ownership, you can't 1031 exchange once you convert your partnership units for shares in the REIT. Another potential drawback is that in order to get this process started, the REIT has to actually want the property that you're contributing. You may have to contact a number of REITs until you find one that's willing to accept it. Next up, we have Delaware Statutory Trusts, or DSTs, which can be a great option for real estate investors looking for more flexibility. Now, don't let the name fool you. DSTs aren't only available in Delaware. There are DST holdings in every state. So if you've ever done a 1031, you know how stressful it can be. If you have 45 days to identify a replacement property and 180 days to close, miss that window and you're stuck with the tax bill. DSTs can solve that problem. A DST is a legal structure that allows multiple investors to pool money together to own institutional grade real estate. Think large apartment communities, medical office buildings, or industrial warehouses. The key here is that DSTs qualify for 1031 exchanges. So instead of scrambling to find a property in that short time frame, you can identify a DST in your 1031 and roll your proceeds into it. A DST is completely managed for you. You don't pick tenants, you don't handle maintenance, and you don't even see the property taxes come across your desk. You simply own a beneficial interest in the trust, and you get your share of the rental income. The result is that you continue to get income and tax benefits, but with none of the management headaches. In addition, when the DST property is sold, you'll generally have the option to 1031 into a directly held property or another DST. There are some limits though. For example, DSTs are generally illiquid. You can't just sell your shares whenever you want, or you may risk having to sell at a discount. And you don't have control over the property decisions like you would if you owned it directly. But for many investors, especially those looking to retire from active management, this can be a great way to keep enjoying the benefits of real estate without the stress. So let's recap. We covered 3 ways to make your rental portfolio more passive. Triple net leases give you predictable cash flow with tenants covering most of the expenses. UPREITs let you roll your property into a real estate partnership while giving you the option to convert your partnership units into shares of a diversified REIT. And Delaware Statutory Trusts let you use a 1031 exchange to move into institutional grade, professionally managed properties with 0 landlord headaches and the ability to 1031 out when the property is sold. If you've been looking for a way to enjoy real estate without the late night calls, these strategies can help get you there. So if you found this valuable, subscribe to the channel for more real estate financial planning content, and I'll see you next time.